All right, so welcome to our webinar number 7 of year 2023, and thank you for attending this on a Monday evening at 8 p.m. together with us. Today we're going to talk about a very interesting topic that a lot of you have actually been asking us to hopefully talk about this particular niche segment, and we're going to dive deep into cluster houses, as well as, of course, another term for cluster house will be Strata Landed. Of course, today's setup is a little bit different because if you happen to look at this cam, of course, we have Ong Yu Rong together, and today we're going to do this together in a little bit like a banter session. Are you ready, Yu Rong?
Yes.
Yeah, and actually, I forgot that because this setup is a little bit different, and please pardon me for my ripped jeans, because I usually wear ripped jeans on my on my days that I'm not filming, and of course, Yu Rong is so well dressed. Why are you laughing? Okay, so very excited to do this together with everybody. Thank you once again for signing up for PRB webinars, and a very quick run through of the 3 main things that we're going to talk about today. So we're going to talk about firstly the ABSD cooling measure, because this came out fresh from the oven 27 April, and I think a lot of you probably are very concerned about the doubling effect on the foreigners ABSD, as well as, of course, second property for Singaporeans is now upgraded from 17% to 20%. You know, should I say upgraded? Okay, later the ABSD segment I'm going to pass to you, okay? And of course, we're also going to talk about a possible underdog segment on whether could cluster houses / strata landed be the dark horse to enter into the landed space in this particular season for the rest of 2023, looking at how landed home prices has escalated. And last but not least, we're going to talk about the disparity price gap effect that we have noticed from our PRB research. And a very quick recap is that our disclaimer for our webinars is that these are meant for education purposes, as well as a lot of the research came from in-house and is based on our experience and opinion. So do take note that property investment, of course, is a financial decision. So do consult your own relevant bankers and do your own financial prudency check before you commit to any form of investment. And our style of webinars is very clear-cut. In the event, if we have any collaboration with developers, the title will be stated up front. And the start of our webinars is that majority, it is on an unbiased approach. There's no product push at the end. The research is not skewed towards any particular new launch or any projects. These are all based on pure research and knowledge sharing. So, who is today's webinar for? And by looking at quiz number 1, that will give us a little bit of insight on who this webinar is for. So, let's kickstart with this very so-called interesting question on if, let's say, you have a budget of $2.5 to $3 million, or maybe up to a little bit of stretching towards the $3.5 million mark for your next home, what type of property should you buy this year? And of course, the set of criteria is that you might be somebody that's looking for at least a 4-bedder upwards. You are very focused on size. You do not want to go for smallish square footage, like maybe 1,000, 2,000, 3 square feet. Maybe you have a minimum requirement that you need to have at least 1,006 square feet or maybe 1,800 square feet. And you hope to see some level of returns in 5 to 8 years' time, meaning that this likely will be your primary residence for you, your family, and your children. However, you hope that in 5 to 8 years' time, after living there, growing your family, you want to see some level of capital appreciation. And of course, deep diving into your particular set of criteria, you might be somebody that would love to have at least a 4 to 5 bedrooms, because maybe you have 3 children and maybe your parents are living together with you. You hope to have more bedrooms. You're okay with either condominiums, you're okay with cluster housing, you're also okay with pure landed properties, but you're a little bit worried that the overall quantum pricing of pure landed is now too high, out of reach for your level of financial prudency check and your entry budget, because all of us has different life seasons. Maybe you're in a season that you hope to go in with a cap of $3.5 million, but now the entry level for, let's say, a OCR pure landed is already at $4 million for a category 1 pure landed home. Later we'll deep dive into that as well. And you also feel that the PSF level of condominiums is a little bit too high. New launches PSF is at the all-time high of all above $2,000 per square foot, and the size is, of course, a little bit too small for your needs. So you hope to have a little bit of the kind of spacious kind of effect, and you do not want to have like 1,200 or 1,300 square feet four bedder in some of the newer launches. And maybe you're contemplating between these four different product categories. First, of course, will be the freehold version of the smallish inter terraces, and I'm talking about terrace number 2, meaning that this type of terraces are found primarily in Upper Thomson, in MacPherson, and they usually range between 800 to 1,000 square feet for land size. They belong to the smallish type, which you can still get for around this price range. And maybe 99 years inter terraces or semi Ds that are maybe in the $3 million range, or maybe 3 million range as well. Cluster housing, and of course, cluster housing has 99 and freehold versions. And of course, you're also okay with 4 to 5 bedder resale kind of condo, which are larger in fashion, maybe some penthouses as well. And maybe you also belong to somebody that can go in at 4 to 4.5 million, and you're contemplating between these two product category. So why is it that you're calibrating between these two categories? Because if you were to go for the pure inter terraces, they usually belong to homes that needs a little bit of work. Maybe you need to sink in another 800,000 for A&A. Maybe you need to do in $500,000 of renovation, and thus you're contemplating between this or maybe getting, let's say, a freehold cluster house that maybe you don't need to do too much work. So this might be your dilemma situation, and we hope that this webinar, at the end of today, you will walk away with a little bit more clarity. And just a quick introduction, my name is Melvin Lim. I'm the co-founder and CEO of PropertyLimBrothers Group. And of course, today with me, we have Yu Rong. And of course, Yu Rong is our senior investment consultant with PRB Realty. So this is our entire team, HQ team, media team, as well as realty team, where all our full-time sales consultants, full-time media people are located together, and we work hand in hand every single day. I've been running real estate for the last 16 years, and of course now I run two companies. And personally, I'm a property investor. I love analyzing real estate every single day. A quick update on our YouTube channel: if you have not signed up, just go to YouTube, type in PropertyLimBrothers, you will be able to locate us in case this is your first time attending our webinars through recommendation from your friends. And for today's webinar, I've also got our digital marketing team to tabulate all our very recent Strata Landed homes. You just need to head on to our channel and look for this particular playlist called Singapore Strata Landed Properties. That will give you a good idea of how strata homes and cluster projects looks like. And later, Yu Rong is also going to help you to give you some clarity on some of the differences on cluster strata, and there's some cluster projects that foreigners are also eligible to purchase, and what are the key fundamental differences between pure landed and strata homes. Now, if you head on to propertylimBrothers.com, you also will be able to look for some homes for your browsing needs. And of course, some of the key things that we have done in the last 12 months was that our 3D team has, of course, done quite a fair bit of work in terms of visualization within the home tours itself. So basically, if you head on to our landed videos, you'll be able to see things like this, that we help to visualize some of the things that you can potentially do once you purchase a landed home. So a quick browsing is that you will see a lot of all these architectural visualization. So what we aspire to do is that we want to talk about the possibilities after home buyers purchase the home, and of course that helps our sellers to position their homes very differently as well. So a quick update on the very recent global uncertainties. Of course, these are news that happened at the first quarter of this year, and just of course in the last week itself, First Republic Bank, of course, also got into trouble. So of course, these are the bank failures that has happened in the U.S. economy. Of course, a lot of people are a little bit worried whether this will escalate into a global recession. And this, of course, came out quite shockingly, because just after the Q1 flash estimate from URA has been released, 27 April, immediately at 11:59 p.m., our government released the latest round of ABSD. A quick recap is that the key highlight is actually not about the second home for citizens. In my own opinion, the key highlight is actually on the foreigners doubling up effect, because this is the first time that we see such a hefty doubling up from 30% all the way to 60%. It seems that there are some underlying data on why our policymakers needs to take such a drastic action. And because of this, our research team then deep dive and created 8 different charts, which later Yu Rong will share with you on some of the very interesting findings. So, why is there a need for this ABSD measure? And I think one of the key rationale is because of the amount of family offices being set up by high net worth individuals as well as ultra high net worth individuals. And this is not a new kind of news, because since the pandemic, Singapore has been one of the highlight globally on how well our country has been managed on the COVID situation, as well as now we have sort of attained the status as a safe haven. Our currency is also one of the best performing currency vis-a-vis the surrounding countries. So that naturally attracts a lot of investors that wants to park their money, in Singapore, because Singapore is safe, stable, good governance, and of course currency strength is strong. So they want to invest in our assets here. And because of this, of course, we are also being ranked as one of the lowest risk in terms of real estate bubble compared to a lot of global cities, which is also a very surprising news to a lot of people, because we thought that our prices are already very high. But one of the key fundamental reasons is because of the past 15 rounds of cooling measures that our government has placed in. And let's have a quick look at the history and impact of ABSD. So these are the totality of all 15 rounds. A quick recap was that the first drastic round came after Lehman Brothers. If you notice, this drop was because of the fact that before the first cooling measure came in, there were no cooling measures. Now, when a country has no cooling measures to curb speculation, what's going to happen is that whenever there are global events or global recession, for example, like October 2008 Lehman Brothers, you're going to see a sharp rise when there is QE, quantitative easing globally, where the money supply is increased, a lot of liquidity flood into the entire country. And 2006 was actually the period where US was recovering from their subprime crisis, and there was a lot of QE that was being injected into the money supply. 2006 was also the season where Singapore announced the construction of 2 casinos, and that actually sprouted a lot of interest, and there were a lot of speculation activities in the past. And when a global recession strikes like this, immediately volatility happens. This is the result of the so-called free hand approach, whereby there's no government cooling measures being injected to control and curb speculation into the property market. And of course, if you notice the past years from 2008 until today, which is about 15 years already, we already have 15 rounds of cooling measures. And because of this, with the cooling measures injected, you don't see as much volatility in the property price index. And of course, that is a good thing, because without cooling measures, we're going to see a lot of speculation continuously. And I think what our policymakers want is that they want a stable price growth for overall price index on landed, non-landed, as well as HDB pricing. And now I'm going to pass over to Yu Rong to elaborate on the evolvement of ABSD, as well as some of the very interesting 8 charts that our research team has came up with to understand what were foreigners buying in the past 12 months, what PR buying in the past 12 months, what were Singaporeans actually buying in the past 12 months, and in what region. Now, Yu Rong, over to you.
Okay, thank you, Melvin. So you can see that actually for ABSD, this is not the first time we have additional buyer stamp duty. So additional buyer stamp duty basically means that every residential property purchase will actually already have a buyer stamp duty that you need to pay for every profile of for every profile of the purchaser. You always have to pay a buyer stamp duty when you purchase a property in Singapore. So if you are acquiring your additional properties, or depending on your citizenship, you might be required to pay this thing, what we call the additional buyer stamp duty. So you can see, of course, we have total 5 rounds so far under the additional buyer stamp duty. First round being implemented in 2011. So we can see that when it first started, it was the main increase was at a foreigner to actually curb the inflow of funds because of quantitative easing. That in short, basically, US printed a lot of money. We want to make sure that liquidity don't inflow and actually push up our prices too quickly, such that it's not so affordable to Singaporeans. And so you can see that when it was first implemented, 10% for foreigner purchase. Subsequently, you can see on the round 2 of the additional buyer stamp duty, that is where the government has a standpoint in terms of there is some differentiation in terms of Singaporean versus PR with regards to their first purchase. Meaning that you can see that for first purchase, Singapore citizen will still be at 0% additional buyer stamp duty. However, PR has now 5% for their first property. And you can see that consistently, additional buyer stamp duty, right, is meant to make sure that investment influx of funds locally as well as from other countries do not push up prices so quickly such that it becomes unaffordable for especially first-time homeowners. So you can see that out of our rounds of changes in terms of the additional buyer stamp duty, you can see that first property, Singapore citizens is still at 0% tax and PR still remains at 5%. And along the way, now the most drastic change is that we can see that for foreigners, it will be 60% if they were to buy, if they were to purchase a residential property in Singapore. And something interesting is, after this measure was launched, so for Blossoms by the Park, we still have 8 purchases done by foreigners. Of course, in terms of the citizenship of these foreigners has not been fully disclosed. If they are US citizen, of course, we will understand that because of ABSD exemption for foreigners from the US citizenship for their first property, they are treated like Singaporeans with no additional buyer stamp duty. But on the ground, we do know that there are at least 2 or more that foreigner citizenship that has to pay that 60% additional buyer stamp duty rate. Of course, you can see that the first time we sort of like do a doubling is from ABSD 2 to ABSD 4, and now we double up again to ABSD 5. And you can see corporate entities will be an additional 5% in terms of additional buyer stamp duty rate compared to foreigners. So these are assuming that corporate entities are being used, companies are being used to actually purchase and hold the residential property, i.e., for example, family offices, where foreigners set up these offices to actually manage their wealth in Singapore. In the 5 rounds of additional buyer stamp duty was introduced, so we also plot it against to see what is the percentage change in terms of the residential private property price index from the previous quarter to see what is the impact like from the ABSD on our HDB price index, our non-landed price index, as well as our landed property price index, which actually covers the condo and apartment segment. Right. So to break it down simply, for you all to understand, in summary, we have showcased over here in this table at a glance. After each ABSD was introduced, number one we want to know is what is the percentage change in the property price index in the subsequent quarter. And we are specifically comparing for the non-landed private property price index segment. And we also see how is the volume of, what is the volume of transaction, how has it been changed. So we have the volume of transaction in that quarter when ABSD was announced and the volume in the next quarter after the ABSD was announced. So in general, you can see that, number one, in terms of percentage price change, we can see that it is almost that the ABSD introduction in terms of the cooling measure do not have a very strong direct impact in terms of bringing down the property price index prices. And secondly, you can see that actually in most of the cases, you don't see a major volume dip after the ABSD was being introduced from ABSD 1 to ABSD 3. Of course, there are some volume changes that we can see over here in the last round of ABSD that was introduced in December 2021. Yeah. That's when the first time we actually give a 30% ABSD for foreigners.
Correct. Yu Rong, this part I just added a little bit. So of course 2021 is also a little bit different because if we can recall for 2021, this entire year was what we call the year of I would say superb performance, because this was the year that of course everybody was recovering from COVID, and then they were just entering into the market. Interest rates were at all-time low, and of course straight away after December 2022, we entered into the Black Swan year, which is year 2022. And 2022, there was a lack of new launches, and of course interest rates started to escalate. There's Ukraine war, stock market started to crash, and 2022 was the year of the Black Swan. So if you notice, there was this extreme high volume for the year of 2021, which was not seen in the previous era during the 2018 season. So just to take note that this was a year that was a little bit special. Let's continue.
So in summary, why the ABSD measure do not actually bring down the property price index, and why is it still relatively stable after the ABSD was introduced? And generally, that is the reason is because the bulk of the buyers that we have in the private property segment, they are mainly Singaporeans, and permanent residents. So you can see in the last 5 years, from 2018 to 2022, if you were to break down in terms of the number of transactions done in the condo and apartment segment, in terms of residential status, the main bulk will be Singaporeans still at 77 to almost 80%, and foreigners are hovering at the range of 4 to 6%. Last year is about 5%. So in summary, our residential property prices, we are not heavily dependent on foreigners, which is great, because what it means is that like when the liquidity comes in, it does not prop up prices, and when there is another area or another location where it is more attractive to these foreign funds, you can see that funds being poured and we can see prices dip in that scene. So you can see that generally when the market is not dependent on foreigners and they are mainly owned by locals, it means that it makes our private property space very stable in terms of pricing. Okay, so some interesting charts that we have by our research team on who is the nationality that is buying our non-landed residential properties. So these are your condo and apartments. And you can see, of course, we mentioned that generally it's predominantly by Singaporeans over here. At Q1 2023, it's at 75% done by Singaporeans. And at the lower ends, actually, we have plotted out in terms of what is the percentage in terms of buyers that are from other countries like China, Malaysia, Indonesia, India, as well as the USA. And these numbers are actually based on a combination of permanent residences as well as foreigners from the country, and then they take a much lower percentage with, of course, the Chinese citizens and Chinese PRs as well as the Chinese citizens taking up most of the percentage in terms of transactions. But what is interesting over here will be, so in this chart where we only focus on the foreigners, we can see who actually takes up the most percentage in terms of the buying rate. So you can see, of course, the highest is by Chinese investors, hovering at 41% for this quarter of 2023, followed by Malaysian investors, Indian investors, US investors, Indonesian investors, as well as companies. But what's interesting from the data is that we also look at when foreign investors come to Singapore and purchase our non-landed residential, what are they actually buying? What kind of location? Are they buying our core central region, where that's our District 910, our prime location, or our CBD areas like District 1 and 2? Or are they buying our outside central location, where it's like your Punggol, Sengkang, your Jurong, your outside central region? Or are they buying our rest of central region, like places like Queenstown, Marine Parade, etc.? And are they actually looking at the resale properties, or are they looking more at the new launch properties? So you can break down in terms of percentage-wise. You can see that in the last 2 years, from 2021 till date, generally, the participation level for foreigners is actually the highest in the outside central region resale properties. So 40% of the purchases done this quarter actually bought into a OCR resale condo, and only 6% of them goes into new sale. Of course, we have a good participation rate in terms of the core central region at 16% and 14%. And of course, I think that a lot of times there is a lot of mindset in terms of thinking that when foreigners come in to purchase, they usually come in to zap up our luxury product. Of course, I think on the ground we always have the thought process that, okay, when foreign investors come in, number one, they will take up our luxury condos, or they will be actually aiming at all the core central region properties because of the freehold status, or it is because that it is located in a more prime location. However, statistics show that in the last 2 years, outside central region properties actually appeal quite a lot to foreigners as well. So if we look at the permanent residence chart, it also displays a similar trend. Where most of the people are actually flocking to the OCR resale areas, and it is similar across the board for Singaporeans as well, where they are buying the outside central region resale properties as well. And also, one thing to note is we want to see when foreign investors come to Singapore, are they looking more at resale properties, or are they looking more at new sale properties? So you can see that from this chart, I would say that about 70 to 80%, generally, they are buying into the resale properties in Singapore, and foreigners are buying probably about like 25 to 30% in terms of the new launches, in terms of transaction volume. And this is very consistent throughout the PRs as well as Singaporeans over the last 2 years.
Great, thanks, Yu Rong. And of course, to sum it up, based on what Yu Rong has shared, OCR resale tends to be the dominated kind of region and the type of properties that is most demanded by locals plus foreigners. So basically, this dispels a little bit of the myth that we have always been thinking about, right, Yu Rong? Like, we always thought that, you know, foreigners and maybe PR investors, they only want to buy CCR properties. But it seems that we also have that misconception that they only want to buy brand new launches. And this sort of actually answers a little bit of the question that we have on why our policymakers is so direct this time round to come in and double up from 30% to 60%. I think predominantly is because of this reason that a lot of the resale OCR portion are now, of course, being one of the most interested regions and type of properties that foreigners and PRs are also interested in. So that can, of course, potentially so-called rise up the OCR pricing a little bit faster, because I think this time our government is a little bit worried about the velocity of the strength of the uptick in terms of property price index. So velocity means the speed and the strength of the money coming in into this particular segment. So if you were to look at this chart, actually the URA price index in the last quarter sort of plateaued at 0.4% overall, landed plus non-landed. But this quarter, just in Q1, it went back to about 3% and it combined at about 3.2% for Q1. So it went back to the speed that it was enjoying in the year 2022. So it went back to quarter 2 and quarter 3 2022 kind of acceleration, which was at about 3 to 4% per quarter. So basically, if you look at our past 11 years, we had about 75% of growth rate, and we talk about 2012 all the way to 2023. That was a 75% growth rate in terms of condos and private apartment pricing acceleration. And just in the last 3 years, 2020, which was the pandemic season, all the way until now, we already see a 22.4% growth rate. So in totality, if our policymakers were to allow the acceleration to continue without stepping in, what's going to happen is that for this entire year in 2023, we're going to see about 14 to 16% acceleration in our URA price index, which means that in 7 years' time, if this continues, we're going to have about 100% increment. You just take 7 years times about 15%, that's about 100% increment, which also means that if this is not checked, if the acceleration goes on, what will happen to a 3-bedder in OCR by 2030 in 7 years' time? I think, you know, how much do you think a 3-bedder will be? I mean, let's take, for example, a Tampines 3-bedder, which is at about... Right.
Double up, that would be $3 million for almost an entry price kind of condo apartments in the outside central location.
Yeah, and I think the concern is real, because if you look at just the charts that you has showed, a lot of interest, even for PRs and foreign investors, are now in OCR resale. And of course, that acceleration might even escalate more than 100% if this were to continue. So thus, I think maybe our government is looking at about a 50% kind of range rather than a 100% range, because I think they do not want to collapse the price index, because that will also be very unhealthy for the overall pricing in our residential properties. They will want to see a little bit more stable growth rather than a kind of accelerated growth in terms of the speed. So moving on, just to summarize for everybody, I think some key things that we can look at is that firstly, the 60% will definitely have an impact on a certain segment, which might be foreign investors with a certain quantum range. Because, for example, if somebody were to buy a $2 million property now, they have to fork out another $1.2 million for the additional buyer stamp duty. And that will bring the total investment cost of 3.2 million. Maybe the high net worth portion will be slightly delayed in terms of their entry. They might go back to renting, maybe in the CCR or RCR region, or maybe OCR region. Ultra high net worth, in my opinion, I don't think they will be affected, because if they really want to park their funds in Singapore, I think they will do so as well. However, maybe the high net worth segment, maybe somebody with a range of maybe $3 to $10 million, they might put on hold. They might go back to renting first, or maybe they might dive into commercial property. So, for so-called Singaporeans and of course PRs, I think if you are planning to buy something in this season, then try to have that kind of mentality of thinking about properties that in future, if 5 years time you want to exit, what will Singaporeans and PRs be hunting for? And where are Singaporeans and PRs buying? Look at those type of properties, and thus that will then better help you to have a little bit more clarity. And of course, we want to also talk about continuing rising interest rates because, of course, the rate hikes doesn't seem to be stopping unless, of course, Fed decided to pivot this year. But what is the impact of high interest rates again? We have talked about this at length for a couple of episodes on August on the Go. We also talked about this on some of our webinars, but just a quick recap is that even though the rates has been risen in the past, I think we already have how many rounds of rate hikes? About 8 rounds already. This is basically to tame inflation. About 10 rounds? 9 rounds. Okay, thanks, Ron. And there's also a... Huh? It's okay. And of course, there's also an impact on our borrowing capacity. And if we take a step back, all these are actually good implementation because what MAS wants is that they want to make sure that Singaporeans, they want to make sure that property investors, they buy and invest properties with prudency. Nobody is over leveraging. You minimum must make sure that your TDSR is healthy. You don't have an over commitment on your personal credit card or car loans and stuff like that. And you have a minimum of 25% down payment, buyer stamp duty 4 to 6%, and everybody enter with a mindset that you have to hold for at least 3 years. If not, you'll be taxed with seller stamp duty. So I think with all this combined, as well as the increased internal stress test with the bank, this actually adds to the stability of the residential price index. And yes, Ron.
So can I share a bit
Yes.
on the impact on the borrowing capacity?
Yes.
Because based on the last cooling measure, what we know is that like the stress test rate has increased from 3.5% to 4%. The last time we have been using 3.5% as a stress test rate since when total debt servicing ratio was first introduced in June 2013. So we use it for like a good 9 years. Right. So the good thing is that like the banks has always been very prudent to assess a borrower's eligibility by assessing at a higher interest rate, even though interest rate have been hovering at under 2% since when it was first introduced in 2013. So when we make the adjustment in 30th September 2022, when we increase from 3.5% stress test to 4%, what is the impact? The impact is that borrowing capacity for somebody who is going for a 30-year loan tenure actually reduces by 5.9% in terms of their affordability in terms of loan. But one thing a lot of consumers might have missed out is that in the latest round of cooling measure in September 2022, the stress test rate is increased to 4% with an asterisk sign. It also needs to be taken into account if the thereafter rate of the banks is actually higher than 4%, the banks actually have to use a higher stress test rate in terms of loan eligibility. So that is why we have this chart. You can see that actually most of the banks are now using 4.5 to 4.75% of their stress test rate. And in summary, how does it impact is it has reduces affordability in terms of to 8.5%. So in summary, after the 30th September 2022 cooling measure change in terms of stress test, right now affordability based on 4.7% interest rate compared to 4%, it has overall reduced a person's loan ability by another 8.5%.
Yeah, thanks, Ron. And I think the important question to ask ourselves is that with all these things being in place, why is it that our price is still rising? Is it because in terms of prudency level, in terms of the amount of so-called capital that the average Singaporean family has accumulated over the years that they have built up in their assets is very different from the past? So in terms of ability level, is it because of the fact that there's also foreign money that's coming in, plus a host of all different factors that our price index remains resilient? Now, we want to, of course, come back to this chart a little bit, and I think you all have already seen this chart before. Basically, out of the past 7 rounds of rate hikes in terms of mortgage interest rates, there's only 1 round during Asian financial crisis that our prices has came down, but the rest of the rounds is still increased in terms of our price index. And of course, this time round is no different, even though for the entire 2022 until today, interest rates has went up so many rounds, but our price still went up until the very reason that our government needs to come in with another round of ABSD cooling measure. So our so-called thought process is this. Now, I think we all need to go back to the fundamental reason. The very reason why Federal Reserve raised interest rates is because they want to curb inflation. And inflation has seemingly came to take an effect, is now down from 9.06% from June 2022 to 4.98% in March 2023. Same for Singapore. Similarly, we're also seeing like a moderation of our core inflation rate. So if inflation rate has started to ease, what is going to happen in next year? Because after inflation ease, will mortgage rate starts to come down? And our question, of course, is that when interest rate starts to come down, what is going to happen to the asking prices of developers of their new launches as well as the resale condo and landed owners? And of course, to ask ourselves this question, if let's say you were currently owning a two property or three properties, or maybe you're owning your primary property right now and you're planning to sell and exit and move on to your next home, when you flip the newspaper tomorrow and you see that interest rate drop from 4% to 2%, will you raise your asking price or will you lower your asking price? And what do you think, Wrong? Yeah.
I think number one, a lot of people that I hear on the ground is okay, they want to wait to come in to purchase when the interest rate is lower because number one, if you compare across to other international, if you compare to other countries, usually there's a correlation when interest rate goes up, prices will tend to start to plateau and then drop. Rationale is because the affordability is being reduced. But I think Singapore is very unique because of the total debt servicing ratio, like we mentioned before, that was introduced in June 2013. When interest rate is around 1 to 1.5%, we are already giving rates out as though it is 3.5%. So you can see that when rates actually increase by 10 times in 2022, we can see that affordability do not drop drastically, even though I mentioned that there is still some spillover effect in terms of reducing affordability, but it doesn't drop so much that it will like have a drastic in terms of pullback in terms of pricing. So that is point one. And generally, we all expect that from a consumer standpoint is when the interest rate is low, generally the demand should increase because now it is easier to pay my monthly installment. There will be a renewed interest in terms of coming in from an investment standpoint as well. And if you are the seller thinking from all this increase in demand, it is very likely that asking price will be raised instead of staying the same or reduced when interest rate comes down.
Right. All right. So this is the final point that we're going to talk because of the global uncertainty. Of course, if you were to stay tuned all the way with us on this webinar, at the end of this webinar, there'll be a QR code for you to scan on a freebie PDF research pack. And of course, in this PDF pack, you'll be able to look at the disparity price gap of Strata Landed homes in Singapore. And of course, I promise you we're coming to the Strata segment very, very soon. And of course, let's just move forward with this segment here. So basically, I think the core is that with all this global uncertainty, what we believe is to stick to fundamentals. And of course, let's just have a very short quiz and let's see which country will we buy a property in out of these three countries, A, B, C. So perhaps maybe you can take part in this quiz together with us by keying in your question, by keying in your choice in the chat box below. And of course, for the context of all our webinars, feel free to key in your questions in the chat box. And of course, what our team will do is we'll tabulate all the questions. By the end of the webinar, within the next 7 days, we'll send out the questions and answer in the PDF Q&A pack to everybody's email so that you can look at all the questions and answers accordingly. Now, let's come back to this quiz. Country A. So if we were to select A, B, or C country to buy a property in, which one will you go for? Now, country A is basically this. No population growth. Basically, the population seems to have stagnated. There's mainly local population, not too much population from foreign countries, new immigrants, and of course a very little expatriate pool. Not much economic growth. Country is huge, too much land, too much supply. When even if you were to buy a property to want to invest, you'll find that the vacancy rate is very high. It's very hard to find tenant expert because there's just too much supply. And when you buy a new property within the next 1 to 2 years, there's a lot more new supply coming up, new launches by developers. It's like endless supply. And thus you find that even if you were to buy a property, the property price seems to stagnate and it doesn't appreciate. And even rental return is not fantastic. Most of the time, the vacancy months is so long. And thus maybe you are thinking, hiya, I just buy one property for my own stay, or maybe I'll just rent, and the rental is not too high as well. So this is country A. Now country B, good population growth, prices goes up very fast, lots of rental demand, lots of MNCs, global investors, and of course so on and so forth, and the government doesn't step in, and it has resulted in a lot of speculators. People buy and sell, they flip the properties, they of course over leverage, and prices goes up. Whenever there's a global recession, price comes down and it goes up again, and you find that it's very volatile. You prefer to stay out of the market. Now let's have a look at country C. Country C is quite similar to country B, but the government chose to step in every point in time when prices rise too fast. Of course, you might get a hint that country C seems like Singapore, and of course, country C is Singapore. And we want to put the question to you is that whether is it A, B, or C? Sometimes, end of the day, it's a matter of our choice, preference, and also our investment mindset. So, will you invest in country A? I think no. And country B, will you invest in country B? And of course, just to do a recap, country B actually was Singapore prior to 2008, where there were almost no cooling measures or very little cooling measures, because only after the Lehman Brothers crisis, our policymakers decided to step in, and they were on high alert mode. And in fact, all the 15 rounds of cooling measures happened after 2009. And that was actually country B before. So it was Singapore before 2009. And country C is where we are right now. So end of the day, whether we choose A, B, or C, I think sometimes we all have different rationales to stay out of the market, to try and time the market. For example, country A, we might think that, hey, if I were to buy a property, it doesn't make sense, it doesn't appreciate. Country B, if I were to buy a property, the price volatility is too fearful for me. I want to stay out. But even now, we're in a situation that we are very blessed to be in country C, where our price growth is stable, government takes an active step. But sometimes it's because we want to time the market and we didn't understand about the macro picture. We might also choose to stay out of the market because we also say that, hey, now ABSD has came in. I think price is going to come down. I want to stay out of the market. So at the end of the day, I think if we can understand macro factors, it will help us to focus on opportunities rather than cooling measures, and rather on problems, because every season there are opportunities for you and for me as well when we look at the macro factors as well as the micro factors. And we hope that this series of webinars is going to help us together. And the next part is that we're diving into Strata Landed. And if we want to really understand whether Strata Landed is something that we should stay out or we should explore in terms of opportunities, we need to understand the demand and supply portion. So let me maybe just share on this fundamental economic terms. So basically in real estate, demand for a particular type of real estate comes from understanding, about the population figures that plays a big role in terms of demographics. And of course, population growth happens when there's economic growth. And of course, that is what our policymakers has been pushing for. We want to make sure that GDP in Singapore is at a healthy level. And when we look at the amount of supply as well on the other end, and later I'll come back to demand again. So demand, of course, comes from economic growth, population growth, that spurs demand. And a country, if it doesn't attract population, there's no demand for its properties. Now, on the supply side, basically, this is where we're at right now in terms of the segregation of residential properties. And 75% belongs to public housing, HDB apartments. We have about 350,000 now for condos and apartments. And we have about 73,000 for landed. And to hover on, we also talk about the fact that for our non-landed segment, this, of course, right now has about 70,000 units being owned by foreigners and PRs, 262,000 being owned by Singaporeans, the core implication here, not say really an implication, but maybe the understanding of this behavior mechanics is that foreigners that already own the residential properties, they will not sell the property very likely, because a foreigner that has bought before 27 April bought a residential property at either a 12, 15, 20, 30% ABSD, but now if they were to sell, they have to buy back a residential property at 60%. So because of this dynamics, all the more, if I'm a foreign investor, I will not sell my residential properties. I will hold on to it. I will continue to enjoy good rental. I will just leave it there because there's no reason for me to sell and buy back at a higher ABSD. Now, because of this, our price index is going to be, in my opinion, more sticky and more stable, because I would say that this base level is now stuck. And this is basically the fluid level at the top portion. Now, coming back to landed is 73,000, and this is very inelastic because there's almost no new supply, and that forms 4%. And of course, landed homes has, of course, escalated in terms of pricing. Now, to enter a OCR, inter-terrace home, minimum, you are looking at about $4 million. But what about Strata Landed? Is that an opportunity for Strata Landed home? Because could this be a hybrid? And in terms of the entry price right now in 2023, could the next leg up in terms of capital appreciation belongs to this segment? And we want to look at this because if we were to deep dive inside, and our research team has tried their best to look at real list, URA, we have sieved out every singular kind of unique addresses as well as transaction volume. And although there's no clear data, but based on our best ability all the way from 1995 until today, plus minus unique addresses gives us about 5,200 in terms of the types of addresses that Strata Landed is now placing on. So we also came out with this entire distribution of landed volume over the past 1995 until today, which is about 28 years. And this is basically the entire segregation breakdown with this chart at the center right here. Of course, we see Strata Landed having about 13,000 transaction volume, 8,000 plus of them belonging to freehold, 4,000 plus belonging to 99. But in terms of unique addresses, there are only 5,200 of them. So could this be a segment to look at? Now, this is the distribution of Pure Landed, distribution of Strata Landed, and coming back to the supply side again, this is what is going to happen in 7 years' time. So in 7 years' time, 50% of population will be Singaporeans, 50% foreigners. And why is that important? Because if we were to add the element of strata homes into this entire table, the important portions to focus on will be the red bars that stretches across all demand segments. Basically, if let's say you're planning to buy an asset, we want to look at which particular type of asset has more limited supply and a bigger demand pool. Because when you own this type of assets, basically it is more inelastic in the sense that the supply is not easily increasable. And you are owning something that has limited supply but yet international demand. And of course, we want to look at Strata Landed because it does spread across this entire portion. Of course, most Strata Landed can only be purchased by Singaporeans, but there's a core segment that foreigners and PRs can buy. Later, Yu Rong will dive deep with you. But the important thing to note is that it is only 0.3% of the entire residential property stock in Singapore. Because in the entire residential stock, we included HDB. We add everything together for residential without going into GCB, shophouses, and Sentosa Cove. We're looking at about 160 over thousand. Sorry, we're looking at about 1.6 million residential stock. And Strata Landed seems to be, it could be also one of the dark horses that could prevail in the year 2023. So, before I hand over to Yu Rong to dive deep into cluster housing, end of the day, I think one of the rationale that we want to talk about this part where it is important to buy an asset that has a stronger demand and little supply is that now our names are so precious. Because of ABSD, second property now has increased to 20%. Our names are even more precious. So a family that's dual income, max out at 2 properties because your second property investment is going to be a 20% ABSD. And of course, if you don't want to go into debt, then your first primary property is very important. We have already moved away from the past trend that a lot of investors in the past, they bought multiple one bedders for investment. Because now your names is so precious, TDSR in terms of borrowing capacity has dropped. We want to make sure that the first property you are buying something with good capital appreciation potential. So in economics, last but not least, it's important to own something that has more restricted supply if you have the financial capability. And of course, all is good. Even if, let's say, you were to, of course, own a HDB apartment, what we're trying to say is that there's nothing wrong with owning a HDB apartment, because a HDB apartment is basically a place for you to build your family. It can be your first property to enter into the property portfolio segment, and maybe you will upgrade in future. But even if you were to stay in your HDB apartment, that is all good for longevity as well. But what we're trying to say is that HDB apartment is not meant as an investment vehicle. It's meant for your family growth, family building. And if you're into property investment, you want to dive deep for capital growth, then look at segments that has a more inelastic relationship of supply versus price. And what we mean is that the more inelastic your price to supply ratio is, for example, when we look at landed, no matter what happens, there's not going to be GLS for landed property, because all GLS are reserved for high rise. Our land is scarce. It is not productive for any land to be for landed properties anymore. So naturally, when our government introduces GLS, they are meant for high rise BTO, or they are meant for high rise condominiums and apartments. And thus, even when prices of landed increase, supply cannot increase. Supply is stuck. And thus, this presents an inelastic kind of relationship. And of course, the better will be the appreciation for landed homes. And this is basically a hardness effect of asset, basically all the way from the most elastic kind of property asset all the way to the most inelastic. And where does basically strata comes in? Strata basically comes into this particular segment here. And the reason why HDB apartments are elastic is because, just have a look at this. Whenever we see the $1 million news of HDB properties, immediately it attracts more policy in. And when you talk about soft to hard asset, basically we categorize Strata Landed into this segment here, because it falls between a dilemma zone that a lot of buyers have when they want to think about condos as well as landed, but it also presents an opportunity. And so to sum it up, Strata Landed demand increases usually when the following happens. Because sometimes in the past, I think a lot of buyers and investors, they might be thinking of Strata Landed as something like a hybrid, and they will think that, hey, Strata Landed, it seems to have high MCST fees. I'd rather go for landed with no MCST. But at the same time, there's a category of buyers that wants to enjoy facilities. They also don't want to maintain pure landed property. They want the MCST and management to take care of external leaking, repainting and stuff. They just want to take care of interior, and they just want to enjoy the Strata Landed in terms of the built-up area, in terms of total strata space, because most of the Strata Landers, they are either 2,000 plus to 5,000 square feet of total build-up. They have more bedrooms. They are spread on different levels. They look like a landed home, yet they are in a community with facilities as well. And thus, sometimes a hybrid group of buyers, they want to enjoy this kind of strata benefits, but they don't want the maintenance of a pure landed. And thus, they might contemplate and look at strata homes. And usually, the demand and price of strata properties increases when there's this phenomenon happening in the market, which is there's a growing pool of buyers that are hunting for large condos or landed, but they find that the entry price of pure landed is now at a new level. And they usually find that the PSF for condos is also at a new level, and new launches are getting too small. And when they look at strata homes, they find that, hey, in terms of PSF, it seems to be lower than new launches. In terms of overall quantum, it's also lower than pure landed. So could this be an opportunity? And this part, I'm going to hand over to Yu Rong. Come, Yu Rong, take it away.
Cluster housing refers to when you only see landed homes within a gated community. But the reason why it is strata landed and not what we usually call like a pure landed is because for strata landed, you don't own the land where this property is sitting on. So it is closer to like a condominium, where the residents do not own the specific land plot, but they all have a common interest in the land plot, and hence it is strata subdivided, and we all own a value. So in a condo setting, all the residents do not own the land individually, but they own a strata interest of the land. And so cluster housing falls in a similar category. And townhouses usually means that in that project itself, you have a combination of condos, and you also have you also have individual landed homes. And these landed homes within this combination, we call it like townhouses. Okay, but in summary, they are all under Strata Landed. And an example of a cluster housing is, for example, Belgrava Villa. So you'll see something like that. Either a gated community only see landed homes. So importantly, I think let's have a broad view of what is the difference between a landed home versus a Strata Landed. So number one, when it comes to land ownership, point one is, as a landed owner, you own the land that you're sitting on. In a Strata Landed, you don't own the land, but you own the strata space, just like condos and apartments. And of course, can you rebuild, do any addition and alteration, as well as change the facade? So number one, of course, for landed, you can tear down and rebuild because you own the land. In the Strata Landed, you cannot change the facade because everyone in the gated community has to maintain the same consistent facade. In terms of PSF, it is also very interesting because sometimes you will see Strata Landed, how come in terms of PSF range, it is so much lower than a landed property? Because for a landed property, number one, when we see the PSF, it is based on the land size that it's sitting on. Usually, so for like terraces, it can be 1,500 to 2,000. For like a semi-D, it can be 2,001 all the way until like 5,000 square footage or land size. And hence the PSF will be slightly higher than the Strata Landed, where the PSF is actually based on the entire built-up area, means all the usable space. Next is security. Of course, landed, you have your own gate, you don't have an additional security. Somebody can still go up to your door and knock your door. But for Strata Landed, it has a gated community just like a condo, and they will need access through either the security guard or through the automated gate in order to even access the project itself. In terms of facilities wise, of course, landed, there's no facilities. At bigger homes, of course, some owners may choose to build their own lap pool. Usually, that is for like a semi-D or like a detached kind of properties. For homeowners who prefer to have some facilities, then they will consider Strata Landed, which mostly comes with some facility, usually a pool. And next thing, we talk about maintenance fee. So for a landed property per se, there is no maintenance fee that you have to pay on a quarterly basis. However, if there's any major repairs, roof leakage, then it is up to the homeowner to undertake. And usually these repairs are more costly because it comes in a few years, but it comes in a bigger lump sum. Whereas in Strata Landed, think of it that you have the similar maintenance fee like you pay in a condominium every quarter. So you're actually contributing consistently for like a small emergency fund. If there's any repairs required, this will be taken care of by the management. Okay. Next thing, in terms of tenure, of course, for both landed and Strata Landed, there is no difference because there is both a leasehold and as well as a freehold or 999 kind of tenure. And importantly is, can foreigners actually buy a landed home or a Strata Landed? So in short, foreigners cannot own landed residential land in Singapore, and so foreigners cannot buy a pure landed kind of property. However, some foreigners are given the approval to own a landed property if they fulfill the requirement from the Land Dealing Authority unit. So can foreigners own a Strata Landed? So it will highly depend on what is the status that the project is classified under. If the project is classified under a condo status, then foreigners will be eligible to own the Strata Landed within that project. However, if that project is classified as apartment status, then foreigners will not be eligible to purchase the Strata Landed. So in 2012, also the government has stopped giving out condo status to projects where there is a combination of condo units that are being built up as well as Strata Landed being built in the same project itself. They will not be awarded the condo status. Hence, you can see after 2012, generally you will not find Strata Landed that is newly built that can be eligible for foreigner to purchase. Okay, so this will be a summary of the different points that we covered. So the stock of Strata Landed units in terms of purchaser eligibility. So you can see that not all districts actually have strata homes. So you can see that we don't have strata homes in district 1, 2, 3, 6, 7, as well as 24. As well as you can see for those, we have broken down in terms of 5,200 plus minus in terms of Strata Landed supply. These are the breakdown on the districts they're located at, and how many are eligible for Singaporeans to purchase, and how many are eligible for foreigners and PRs to purchase. So we sums up to a grand total of about 500 units. 500 units that are available for foreigners as well as PRs to purchase. If you want to deep dive, this is a list of projects where foreigners are eligible to purchase the Strata Landed. So you can see, for example, like in the recent times, we have projects like Park Clementi's, Riverfront Residences, where you also see strata homes like Kent Ridge Residence that just TOP last quarter. These strata homes are only eligible for Singaporeans and not foreigners because they are actually built after 2012, where the ruling has changed. But if you are looking at something that is earlier, for example, Skies Miltonia is the project that is the last cut-off in 2012 that still have Strata Landed that is eligible for foreigners to purchase. Of course, in the context that foreigners will still need to pay a 60% additional buyer stamp duty at the moment. This Strata Landed is the only segment where foreigners can purchase in the mainland without a land dealing authority unit kind of approval. So who is suitable for Strata Landed? So I think these are good for buyers who, number one, you want space. However, you still prefer, maybe you are coming from like a condo kind of environment and you still want to continue to have that gated community as well as facilities for your family, then this will be something that might be suitable for you. Next is, of course, if you prefer to have lower major maintenance upkeep like a landed home, then you might prefer to have a Strata Landed where the maintenance of the exterior is actually taken care of by the management. So over here, I think we will discuss how is the performance between the period of 2017 all the way until Q1 2023. And we will be looking at these few segments over here to look at the past performance. So number one category, we're looking at 999 freehold Strata Landed homes, primarily in the outside central region as well as the rest of central region. We are also looking at 99 years Strata Landed in the OCR and RCR, as well as the performance of 999 freehold Pure Landed terraces in OCR and RCR, and these are defined as land sizes that are above 1,401 square feet, as well as leasehold 99 Pure Landed in OCR and RCR, 999 freehold Pure Landed terrace 2 in OCR and RCR. This is like what Melvin mentioned just now, where they are of a smaller land size between 700 to 1,400 square feet, as well as condo and apartments of at least 1,500 square feet of space, less than $3.5 million. The reason why we have shortlisted this is because these are usually the different segments that someone of the price budget of around like 3 million to 4 million, 4.5 million will be comparing with. So let's start off with the 999 freehold Strata Landed in OCR and RCR. Same thing you can see in terms of per square feet wise, it is lower because Strata Landed, it is based on the build up, which is the total size of the property. And general trend, of course, like going up. I'm going to show you the individual charts first and I will do a summary for you. As well as 99 leasehold Strata Landed is also on an uptrend since the last 5 years. 999 freehold Pure Landed, very beautiful kind of straight line. Even 99-year leasehold landed properties are also going up because there is usually a concern over leasehold properties as well, especially in the landed segment where you have a lot of freehold and 999 kind of choices. People are asked actually whether 99-year leasehold landed can actually also have some form of price appreciation, and you can see that especially over the last 2 years, it has a lot of steady gains as well. Terrace 2, which are the smaller landed, has also have a strong price growth, mainly because of the quantum is very attractive because of a lower land size. Generally, lower land size, so generally in terms of the entire price quantum, it is more affordable for somebody who wants to enter the landed segment. And we always share with the clients is that like why PSF is not the only way we should be comparing prices across the different segments, because we do not qualify for loans based on per square feet. We qualify loans based on quantum. Okay. Next is, of course, in the performance of condos and apartments, you can see that they are also generally on like a uptrend. So in summary, let's look at this table in terms of comparing in 2017 quarter one, the PSF done for each segment versus 2023 quarter one PSF done. What is the average PSF percentage change across this time period? So you can see that, of course, generally, number one to notice is for the 999 freehold landed terrace 2, where we have a smaller land size, it has the strongest rise in terms of performance of 89.2%. But of course, in terms of the overall profitability, because the land size is smaller, so the overall profitability will be lesser than as compared to like a freehold or 999 kind of landed property. Both 99 years landed as well as freehold landed, we are talking about terrace in this component, they have all seen a similar kind of price growth, about 60 to 64%. And for strata landed, it is about 31 to 45%, with the freehold and 999 strata landed having more gains in the same time period and percentage-wise over the last 5 years. We also see a good gain in terms of bigger size condo units. So what are your thoughts over here, Melvin?
Basically, when we talk about the strategy of seasons of change and disparity effect, just based on the PSF growth, and of course, looking at what is happening in the growth, as well as the average PSF of this season, this gives us a little bit of so-called hint on what might be the next type of property that has the next leg up. So how does disparity effect work is that disparity effect, in short, is also called substitutional effect, meaning that when this category of product has moved already, will certain new fresh pool of buyers and investors be priced out of this particular product, and then will they start to explore the other type of product that has been so-called the dormant one? Because usually they start to move in tandem. So let me give you an example. When inter-terraces that are freehold and 999 has moved up quickly over the past 2 to 3 years, what has happened is that it has gave rise to 99 years leasehold rendered moving upwards as well. Because, for example, in the past, when freehold inter-terrace was just at an entry of about $2.8 million, people find that affordable, and they start to buy that particular type of property, entering into the pure landed freehold inter-terrace range, and that actually sprouted the price movement upwards towards 3 million, 3.2, 3.5, up to today. The entry level at the OCR area, let's say in D19, is at least at $4 million. So it's very hard to find inter-terrace freehold below $4 million right now. Maybe there are some, but I would say that it's very minute in terms of the amount of listings available. So minimum you need to have 4 million, but because of that reason, disparity effect sets in on the next category. If let's say I want to be in a pure landed, I don't want to buy a strata house because I want to own the land, I want to own the structure, I want a bigger land, I want at least 1,600 square feet inter-terrace land, but I have no choice, because maybe if let's say my entry quantum is capped at maybe $3 million, my next best category will be a 99 years leasehold landed. And that is one of the reasons why they always move in tandem with disparity. And thus, just by this itself, when we look at the average price change, a hint might be in the fact that this particular category that we're looking at in terms of the strata segment, because of the fact that if you notice across all region, they are still either below 1,000 PSF or they are at around 1,000 PSF compared to its counterparts. For example, this is already averagely at about 2,008 to 3,000. This for freehold landed inter-terraces range is at least 1,004 square feet. It's already close to 2,000, and of course, leasehold is also at 1,003. Condos are also at 1,003. Of course, this segment is also something that you can explore, but this seems to have a higher built-in potential for it to set rise, because if all this was still to creep up gradually, this should also go up, but maybe this can go up in a faster pace. And thus, the next disparity that we want to look at is based on a quantum level. But before that, let's dive into quiz number 2 first. So for the context, let's look at this question. And of course, we hope that you can help us by taking part. Key in your response and of course your own observations in the chat box below. So if you have a budget of $4.5 to $5 million, what type of pure landed would you think would be most suitable for you if you have an objective to max out your return on investment in the next 5 years? Meaning that in 5 years' time, your objective is to see capital growth and appreciation, hopefully, and you might want to exit, you might want to do an equity cash out, and this is your core objective. And of course, this might be your property for stay, but you also want to see returns. So this was the generic data in terms of price quantum of OCR regions back in 2022 quarter 3. Of course, right now we are already in Q2 2023. So this was about 3 quarters backwards. So back then, an inter-terrace in the OCR region, the Cat 1 homes, that means homes that needs to be so-called rebuilt or massive A&A, that was at about 3.2, you can get something. But of course, right now at this point of recording, minimally you need to have at least 3.8 million to 4 million. You can't get anything in this range anymore. And this was the price range. And back then, at the same situation, you could get semi-D landed in this price range. So, looking at these 8 sets of price quantum, left-hand side inter-terraces, right-hand side semi-D, which one will you go for? Will you go for, let's say with $4 to $4.5 million? Let's just quickly eliminate this portion here because you can go for either this, or you can either go for this or maybe this. Which one will you go for? So maybe let's take the next 10 seconds to note down a response, and then of course we'll just share a little bit about what our thought process. So maybe we need a countdown timer here. All right, great. So this, in our context, will be a very likely range. Of course, if you get something in category 2 at about $5 million range, then of course, all the more you should go for that. But if let's say you have that ability, 4.5 to 5 million, instead of going for these 2 categories here, this will be a more viable option because of the disparity effect that this has the upgrade in terms of status. You got a semi-D, you got a bigger land, and most importantly is that the status is different. And in 5 years' time, your next buyer will not be in a dilemma situation because they will also be looking at the same thing, that instead of getting an inter-terrace, they can actually get a semi-D. So projection for 5 years later, let's say for example the entire landed market goes up by maybe 20 or 25%, this will move up to the next notch. This will similarly also move up to the next notch. So take note of this disparity effect versus the status level. So with that, of course, during 2021, we released a couple of episodes on Nuggets on the Go channel. And of course, now our Nuggets on the Go has moved on to a brand new channel. And you can just go to YouTube, key in NOTG, you'll be able to locate us. But back then in 2021, which was about 2 years back, we released an episode to share with the audience that it is now time, if you have the ability, to move on to the semi-D spectrum because the price gap between inter-terraces and semi-D was just too close for comfort. And sometimes when inter-terraces prices catch up, semi-D will be the next leg to move. And once that disparity has widened, then it's time for inter-terraces to move up again. So they always move in a seasonal fashion like this, right? And with that approach and that context set last year, let's have a look at right now and see whether can we use disparity gap technique to help us make a decision. And of course, Yu Rong, take it over.
Okay, so let us look at some comparisons between the following categories. And of course, the research is based on the outside central region location. And we are comparing pure landed terrace houses, freehold 999 as one of the control. So we're comparing with freehold 999 counterpart pure landed as a semi-D. We're also comparing with 999 freehold strata landed terrace. We are also comparing with just 99-year leasehold strata landed terraces. And of course, we definitely need to compare 99-year pure landed terrace versus 999 freehold landed pure terrace, as well as freehold 999 strata landed and 99-year strata landed terraces in terms of their counterparts. Okay, and also in order to proceed further, when we say freehold 999, we are talking about leases that are 900 years and above, because sometimes you have all these different numbers. And of course, for leasehold, we are talking about 200 years leasehold and below generally. Okay, so let's start off with the first one, which is starting off freehold 999 pure landed terrace versus semi-D. So you can see how it's the average PSS movement and of course the quantum basis. Blue colors, the ones in blue are actually your terraces and the one in orange are your semi-detached. So at the bottom, the quantum prices is of like the medium quantum transacted in that quarter in the outside central region location. And on the top is just the PSF price movement. So in summary, you can see that previously back in 2020, 2021, early parts of 2022, you see that actually semi-D has more like a window of disparity between terraces because over here, if we just put it simply, on the top is actually the per square feet difference in terms of terrace minus semi-D, and bottom is the quantum difference of terrace minus semi. So you can see that generally, over in the 2020 to 2022 range, you can see it's hovering about averagely 1 million and below, and that's why semi-D becomes a very attractive a price point to enter comparatively to terraces. And of course, now in the latest quarter, you can see that this disparity gap has widened up to 1.6 million. So at this current juncture, we will think that for pure landed 999 freehold terraces, it is definitely a good window to enter.
So just how we were talking about the seasons of change, right now, the widening effect has happened, meaning that from inter-terraces all the way towards semi-D now, the gap has widened. It means that it is now time for inter-terraces to move up in terms of the next leg up. So if we were to look at the next graph, just now Yu Rong has mentioned that now the quantum difference of a OCR inter-terrace freehold versus a freehold semi-D is now averaging about $1.6 million. This presents a gap in the sense that people will then find that semi-D, you need at least 5.5 to 6 odd million to enter into that range. And thus, not those families that might not have that level of so-called affordability yet, they'll definitely fall back to the entry range of freehold inter-terraces at about 4 million. And then that gap is actually wide enough for inter-terraces to start to move up again. And maybe it will close up to 4.5 to 5 mil, and then semi-D will start to then move up. So they usually will chase each other, and usually the chasing factor comes from the entry level first. So this is now repeating itself as of what had happened during 2019, 2020, because back then, a lot of chase work were being done by inter-terraces, and thus when you move up too fast, semi-D presents a window. But now semi-D has already went up by itself, and thus it's time for inter-terraces to move up again. So let's go on to the next one.
So next, we are definitely looking at one of the main topics, which is we are comparing pure landed terraces, freehold 999 versus the freehold 999 of strata landed terraces. And so, all in all, you can see that the blue line is our pure landed terrace, the orange line, in terms of PSF, this is our strata landed, and same thing we are comparing in the outside central region location. So I would say that I think it really depends a lot on like the quantum that we are looking at when you are actually considering whether to go into a freehold strata landed or not. So let's look at some disparity in terms of like the quantum pricing. So you can see that actually at this moment, the quantum difference based on the median transacted price in 2023 quarter one, the freehold 999 strata landed versus the pure landed, in terms of the quantum, I think it is quite along that median kind of range. So of course, in Melvin and my opinion, of course, we will think that really depending on what is the entry price point that we have, if let's say we have something that is about 4 million, 4 over million, it will be better to pursue a 999 freehold pure landed. But of course, if let's say we can find something of closer to the 3.3, 3.4 kind of price-wise in terms of quantum-wise, then this category of freehold strata landed can also be considered. So meaning that if let's say the freehold strata landed is, the freehold strata landed terraces is closer to the 3.8, 3.7 kind of quantum, then we definitely will prefer to go for a pure landed.
Yes, that's right. So let's have a look at the next one. And of course, at the end, we'll summarize for everybody the conclusion in terms of observation for this season here.
Yeah. And so next, we will be comparing of course, pure landed 999 freehold versus 99 years strata landed. Summary wise, of course, just to recap, for strata landed, you will see that strata landed, this is the orange line, and per square feet for strata landed is always lower, much lower than a landed PSF, is because strata landed, we are based on the floor area that you can utilize. Whereas for landed, we are usually basing just on the land size itself. So hence the per square feet for landed will be higher. And when you see over here, what happens is summary wise, you can see that over the last quarter, the difference is about, in terms of quantum gap wise, about 1.26 kind of quantum, right? So definitely we see that there is a disparity there. Later we will conclude whether 99-year leasehold strata landed is something that we will actually advise to go on at the next 3 to 6 months time. So moving on, 999 freehold strata landed versus 99 strata landed. So terraces, which one is actually more appealing, right? So you can see the leasehold are actually marked off by the blue color line, and the orange color line is actually for the 999 freehold. So of course we will expect that per square feet wise, the freehold and 999 should have a premium over a leasehold counterpart, right? So generally is when the gap closes, right, when it's very near, the leasehold and the freehold counterpart is very near, then of course we will have preference to go for the freehold counterpart. So in terms of, of course we also need to look at quantum perspective, right? So right now in terms of the quantum perspective, the difference is about like a 600,000 odd kind of quantum difference, from meaning that the leasehold counterpart has like a 600 plus thousand discount factor from this 999 freehold counterpart.
So this conclusion is this. That means if let's say after you have explored between condos, strata landed, pure landed, and you're very firm that you want to go for strata landed, okay, for various reasons. Number one, you don't want to do maintenance work for pure landed, because pure landed, you own the land, you own the structure. Any leaking from external walls and everything, you have to, of course, settle the roof leaking, you have to settle the walls leaking. There might be extensive work over the years for long-term maintenance. Of course, the good thing about Pure Landed is that there's no monthly MCST fee, because you take care of your own structure, you take care of your own land. Now, MCST, Strata Landed, some of the bigger projects, they have facilities for your kids, they have function room, they have gym, they have a pool, and of course, you pay MCST maybe about $600 to $1,000+ a month. Anything that happens externally is being settled. There's also security on a compound kind of basis. So maybe that might be a comfort level for your family to go into without worrying about all this maintenance work, right? You just settle whatever is interior. So it's the same structure as owning a condominium. So there is an audience for Strata Landed. In fact, I would say that the audience is actually quite wide as well. So if you're very firm on going for Strata Landed, and you're contemplating between a 99s and freehold, in our context for this season, it might be safer to go straight directly to the freehold strata landed. The reason is because the gap is a little bit too close right now for comfort, and that might present a dilemma next time if you want to sell, because your next buyer, that, you know, eventually, imagine you want to sell a strata landed, and you are actually targeting and positioning your product when you want to exit maybe 5 to 8 years later to a specific audience that one strata landed. They will also be in a dilemma. Should they go for 99s or freehold? So in this season, because the gap has closed up, it might be safer to just straight away go for a freehold strata landed. So that's our conclusion for now.
And also, I think like for people who are in this category of purchasers where they are looking for landed property or strata landed, one of the reasons is because they want more space. Most of the time it is for multi-generation living. There is also a higher component where they are thinking about legacy planning, because they have children, they want to pass on the asset down. And there will usually be a slight preference to have a freehold 999 when the price quantum is actually close. So that's why, like what Melvin say, when the disparity gap is close, we go for the freehold 999 kind of counterpart, so as not to confuse our exit audience next time when we want to sell.
Yeah. Okay, but a quick disclaimer is that what we are sharing today is not saying which product is no good, which product is good. We're just sharing from a context of ROI in the next 5 years, because there was a season that we actually advise our clients that they can actually look at 99 strata, because the gap between 99s and that freehold strata was actually quite wide. And that happened about a couple of years back. And of course, we also noticed that there are certain products in the market that 99 years strata is actually fantastic because they belong to a bigger development. There's more facilities, and some freehold strata are actually boutique projects with limited facilities. So we recognize all this pros and cons and things like that. But just for this season, Q2 to Q3 2023, we just feel that based on data alone, from an objective of ROI appreciation, it might be safer to go for freehold strata. All right.
And so the last chart that we have for today, freehold 999 pure landed terrace versus 99 pure landed terrace. Because I think like on the ground, usually many people might think, hey, who will actually be interested to buy leasehold landed properties, right? So let's take a look. So for the blue color line, it actually represents the 999 freehold pure landed, and the orange line actually represents the leasehold pure landed terraces. So you can see that generally they both have a quite a healthy correlation in the sense that both will go up in tandem, and they maintain a similar disparity. So if you look at the next chart in terms of this disparity price figure, you can see that over time it hovers around at the 1.2 and 1.3 average pricing gap. So I would say definitely for leasehold pure landed properties, as long as the lease is not too short, it's definitely still worth considering. Of course, I think what I want to disclaim is that like today we are sharing number one firsthand on a helicopter view, right? Depending on the specific district that you might be more interested in, then we will look at the data differently as from a more micro perspective, it can have some other slight changes as well. So to just summarize all these different gaps, so if today for the next quarter 2, quarter 3 in 2023, depending on the price point, what do I want to buy, you can, here is like one overview to show you sort of like the different disparity in the sense that leasehold pure terraces and leasehold strata terrace, they are almost on the same quantum level. And there is about 1.3 to 1.4 million of price disparity to the pure terrace counterpart that is a freehold 999. Okay, and of course, we also understand that from 99 strata terrace and a 999 strata terrace, the disparity is about 650k thereabouts. And between the freehold strata, all the way until pure terraces, there's about a 750k disparity.
So in conclusion, to make it easier to look at from a holistic level, just based on same ROI and budget entry range, if let's say your entry range is between 3.5 to 4 million, then as best as you can, try to aim for a freehold pure inter-terrace in this season. But I'm quite confident that in the next 2 quarters, this will change, because the next leg up is that pure inter-terrace will start to then move up rapidly. Shouldn't use the word rapidly because maybe we don't want to spark any attraction on ABSD and stuff like that. But I think that the next leg up is that based on the inventory in the market, the quantum of pure inter-terraces, if you are talking about sizable inter-terraces that's like 1,004, 1,005 or 1,006 square feet type terrace number one, this quantum is actually dwindling in terms of quantity of inventory available for sale. So very quickly, minimum you have to have at least 4 to 4.5 million, I think, in the next 2 quarters. So if you can, and you are out hunting in the market, this could be the right one that you can go for. The reason is because the freehold strata, freehold semi-D. So just now going back to the previous chart, right? So just now Yu Rong mentioned this. So I think you can actually screenshot this just for your own reference. The one that with the price gap disparity one. Oh no, just one chart before. Okay. Yeah. So as you can see, if you can go for this range, just do your best to go for the pure inter-terrace, because the next leg up is actually a good $1.5 million gap to
the semi-D,
which is about $5.5 million. So this is a very safe range for you to enter. And
there's also one thing I want to share is definitely when we are talking about freehold 999 pure inter-terrace, in this context, we are talking about terrace 1. Generally, it will be 1,004 square feet of land size minimum. We are not referring to the smaller land plots that we are called terraces 2, that usually hovers around the 800 odd to about like 900 plus kind of square footage. So that of course can have a lower quantum, but because it has really moved up about 89%, highest percentage wise, because of like the quantum disparity. So we are referring to terraces 1 over here.
And of course, this quantum, the moment you enter, they belong to about Cat 1 home. You definitely need to do a bit of work, and you definitely need to maybe sink in $500,000 to $800,000 for renovation. If you want to do A and A, you might go to about $1 million. But at least, whether you do or don't do any work, you can enter and own the land first. Because most importantly is that when you own a pure landed, you own the land. You can let the land price appreciate and take its cost. You can arrange equity term loan arrangement 3 years later and then extract the capital to do your A&E or renovation. So that is of course a strategy to enter into the market first. So of course, if your budget is between 3.2 to 3.5, because at this current stage of a property journey, you might have just upgraded from a condominium or HDB apartment, and you don't want to stretch yourself more than 3.5, that's your max quantum based on your TDSR loan and your down payment ability, then that's all fine. But our recommendation is that out of these three products, do your best to go for the freehold Strata Landed. And of course, the disclaimer is that unless a 99 Pure Landed is a Cat 4 brand new home and you still in the dilemma between Pure and Strata, then this can also be a consideration. We'll talk more about this later. But if this is your range, this is quite clear-cut a winner in this season.
And then, of course, for this category, I think in terms of if you have a multi-generation living with more old folks, I think there will be more options in this category that the house actually comes with a lift provision. So that might be more convenient when you have old folks at home and you don't need to, because most of the landed homes, unless they are rebuilt more in more recent times, it likely doesn't come with a lift.
Yeah.
Right.
All right. Last category. So last category is that if your range is 2.5 to 3 million, then also do your best to go for a 99s because there are still good finds, but maybe they belong to the boutique projects. And it's the same key reason that because of the fact that the 99s counterpart, they are averaging about $2.6 million, it's a little bit too close for comfort towards the freehold Strata Landed version. So this is also a clear winner in this context. And I think we have one more category, sorry, which is if your budget is strictly $2.5 million, but I'll leave the Ballas curve explanation to Ong Yu Rong. If it's strictly like this, then all is good. This is still okay because in about 5 or 8 years' time, you enter at 2.5. New launches for condos will catch up. Resale condos will start to catch up in terms of quantum as well. Very easy to deduce. Why? Because if you go for a OCR new launch now, a 3-bedder, minimally you need at least $2.1 to $2.5 million for entry range, whether is it 3 or 3 plus study. This is still seemingly quite safe, but we need to talk about the 99 years Ballas curve effect. And I'll talk about the 90 years thing first, and then I'll leave the 60 and 30 to Ong Yu Rong. So basically, we have an article on PropertyLimBrothers.com on Ballas curve. We also use it on our moat analysis. And why do I say that there's a 90-year mark is because when you buy a 99 years property, usually if it's before the 10-year-old version, it gets very popular, and a lot of people are hunting for this. There's a target audience that wants properties that are usually about 10 years old or shorter, which is why like TOP properties that just got their keys, they are very popular. Usually in the next 5 to 8 years, they're still very popular. And of course, you need to take note of 60-year and 30-year mark kind of threshold. Maybe Rong share a little bit about this.
Okay, so previously in the sense that 60-year mark was more in the sense of CPF utilization, because there was a period of time where if let's say this is especially more for HDB as in the sense that when properties are below 60 years balance lease, there is a restriction in terms of your CPF utilization. Now we have actually changed to a new format where as long as the youngest buyer plus the balance lease, as long as it meets at least 95, there will be no restriction in terms of CPF utilization. If there is anything below, there will be a tiering range in terms of how much the CPF will be impacted. 30 years is because the last 30 years, the bank do not finance for the purchase of this property. So if let's say a 35-year-old buyer who actually can get a 30-year loan tenure intends and decides to buy a property that has 40 years balance lease, then instead of getting a 30-year loan for this specific property, he will only be eligible for a 10-year loan tenure because the last 30 years will not be financed by the bank. So this is one of the rationale in terms of explanation of Ballas curve. Of course, I would say that Ballas curve standpoint, it is highly correlated to market perception in terms of how 99 years prices will actually depreciate over time. But of course, when we dive deeper into research, definitely we still find a lot of 99 years property still actually having good gains, especially in the last few years, even though they are like balance lease 60 plus years, 50 plus years, etc., etc. But of course, when it comes to trying to exit from a product that we own, one of the major factors is of course market perception as well, right? One of the major factors will also be market perception. And so if what we want to do is to position ourselves to be in the right category where the data and the market perception, they are all in favor for us when it comes to exit.
Okay, thanks, Rio. Okay, let's talk about just two things before we move on to the final segment. So one strategy that buyers and investors use on this concept is that firstly, why do some people go for 99 properties? Because if you go for freehold counterpart, you have to go in with at least a 30% premium in terms of total value. So usually the differential is about 30% plus minus depending on season. So one strategy is that they keep refreshing based on exit and entry strategy. So for example, you purchase a 99 landed or maybe a condominium, and of course it drops to about 90 or maybe 85 years. Then at this point, they exit and then they go for a newer version, and thus the graph refreshes itself. And then of course once it dip back to about 85 years mark again, they exit and then they go for a newer one. So usually they do this because they want to capitalize on the newness of the property. Of course, the other strategy is that if you love the home, you can continue to stay in the home, but you have to take note that the moment it touches zero, the land goes back to the government if there's no en bloc sale. So of course, there's already case studies. There's a batch of landed home in Geylang. It returns back to SLA. The value dipped to zero. The owners get nothing. But of course, we have also sold properties that are in the 20 over year mark. For example, the batch behind Railway Mall. There's also an audience for this because the property is being sold to a retired family, full cash. They came out for a freehold landed. They has made their margins, and of course, they just want to own a huge piece of land for the next 20 over years. So there's also an audience for that. So just to take note of this, think that there are various strategies on how you can actually plan your exit and re-entry. And of course, we will share more and deep dive this during our consult session.
I think most importantly is whichever property you purchase, right, it must be in line with the goals and objectives. So for example, for somebody who is buying a 20-year, 30-year kind of balanced lease property, of course, what it means for them is they likely do not need legacy planning purposes, and they are trying to utilize the least amount of equity to enjoy the same kind of lifestyle so that they can actually draw out the equity for other purposes at that kind of life stage. Right, so what we want is also to give the right strategy that is appropriate to your life stage as well as your goals and your risk profile.
One, before we go to our PLB methodology, is that just to share with you, usually how we deduce based on different seasons and different entry investment range that you have is that if let's say you're contemplating right now in the last quarter, Q1 2023, you're thinking, hey, should I go for a freehold inter-terrace that's pure landed, or should I go for a 99 inter-terrace that's also a pure landed? And this scenario is not talking about strata landed. Then what should be your strategy? Basically, the price range, which this still exists now in this season, is that the Cat 1 homes for pure freehold inter-terraces are about 3.8 to 4. Brand new ones are about 5 to 5.5. And of course, 99 years landed Cat 1 homes that are oldish in the resale market is about 2.5 plus minus. And then you move up tier, brand new are about 3.4 to 3.6. Of course, looking at this context, if you're somebody that have maybe a range of 3.5 to maybe about 4 million, I think if you have 4 million, very clear cut, go for this. But take note that the moment you enter, you have to invest additional amount to beef up the renovation. Right? Of course, if you calculated that all in, your total range is about 3.5, 3.6, and you don't have additional funds for reno or A&A, then this can also be a consideration because there's still a gap from this all the way to this. So this is basically how to look at this from a context point of view.
Okay. And we also definitely observe on the ground that we have also seen owners like what Melvin mentioned. We buy into like a Cat 2 home, we can do some renovation work for stay with the intention that maybe 10 years down the road, with more funds coming, they can rebuild the entire place. And that is especially useful for the property that we entered where the entire build-out has not been maximized. And so it actually presents the additional gap that we can unlock and utilize down the road.
Alright, so we hope that the disparity effect portion has helped you to gain more clarity. But of course, the most important thing is that because buying a property is a huge decision, we want to share with you the last portion of this webinar, which is our PLB methodology, because we're going to conclude, of course, with our free sign up for our consult session back in PLB office, and that is only available to our webinar participants. And of course, a quick recap if you have attended our landed webinar about 2 sessions before. This is our PLB journey maker, and that is how we sit down and go through in terms of the property journey together with our clients. And of course, this is a 5-step process all the way from A, B, C, D, and E. Firstly, is to understand whether is it landed, is it strata landed, or is it condominiums? Why is this asset class suitable for your family's needs as well as your investment portfolio? What is your current season right now based on the entry range that you have? And of course, take note that even if let's say you now fall into a range whereby you're upgrading for a HDB apartment to a condominium first, or maybe even if this is your very first property, it's important to get into the property portfolio journey, because by staying out of the journey, basically what is going to happen is that real estate eats inflation for breakfast. And what does this mean is that you will find that every 1 to 2 years, real estate prices just keeps going upwards. And similarly, the biggest ticket items, for example, the car prices also keep getting higher and higher every season. Now, the core reason is because of inflation. And take note that the CPI inflation figures does not take into account real estate pricing and your car prices. And this is the effect of an increment and expansion of the money supply. And the moment you don't kickstart your property journey, you will get priced up very, very easily. And of course, for this A, B, C, D, and E portion, we respect the fact that everybody is in a different season. You might be a young family, you might be a family that is maybe you're in your mid-30s or mid-40s, and everybody has a different season. This might be a season for you to go into a condominium 3-bedder, is okay. This might be a season for you to get into a landed property, is also okay. But most importantly is that we want to apply different mode analysis and price comparative analysis to help you make the best decision. Most importantly is that step E is a step that is a must-have, is that we don't want to enter blindly. We want to make sure that the asset that you enter, you have a plan and you have an exit audience that is waiting for you 5 to 10 years later, so that when it comes to selling, it's not a painful process in future. So you want to buy the asset that have an existing or future demand for you to exit into. We also talk about the lender mode analysis in the past, which has 3 core components. This is basically to increase the speed of exit as well as the price of exit. And of course, if you have missed out on our previous landed webinar, of course, do come to our landed convention, because we're also going to talk about this as well, where we share some of the tips on some of the future proving things that you need to look out for to reduce unexpected outcomes. For today's webinar, we have our own set of PLB Strata Landed mode analysis as well. And we're going to cover this on our free 45 minutes so-called consult session back in PLB office, only available for today's webinar participants. Do sign at the QR link right here. That's going to bring you to a QR, that's going to bring you to a landing page. You just need to key in your name, email address, contact number. Our client consult team will get in touch with you to fix a mutual appointment. Come to our office for a free coffee session. And of course, if you have seen how we market homes, we are into revolutionary property marketing, because we believe that the old passive method will have a very limited audience when it comes to selling your and marketing your property. And and the way that we help our customers is moving away from the one-man show agent model into an in-house media and sales consultant model, whereby a team of consultants help every of our clients to market their listings to the full potential. Of course, this is our entire team, and they're all full-timers and full-time consultants. And selling a property depends not just on emotional positioning of the home, whether is it on home tour, whether is it a physical showing, is also a lot on analysis of numbers as well. And that's the reason why we're putting so much effort into our motion graphics, to our analysis into every of our home tours. And we also believe in physical staging as well as virtual staging. And with our work over the years, this was the result that we've achieved over the last 24 months to help our clients in terms of speed as well in terms of potential. So some of our signature strategies right here on how we apply them to help clients at different stages of their life. And of course, this is our in-house proprietary system, whereby we live feed the API data of all condominiums in Singapore to score them, so that it helps our clients to make a good kind of analysis and decision when it comes to selecting a particular district or maybe a group of condominiums as well. Now, and most importantly is that we apply disparity effect technique across the selection process, because this is a very important technique to know whether you're entering at the right price, the type of asset they're entering into, whether is it the right product at the right season, And all these factors play into part when you want to exit. And last but not least, we still have about 10 over rounds of webinars for this year, talking about various range of topics from new launches, resale properties, landed, HDB apartments, and of course, selling and investing in the real estate scene in Singapore. Do also support us on our new channel where we talk specifically about new launches, as well as we banter about policies and real estate trends on NOTG. And of course, last but not least, thank you for attending our PRB webinars with myself and Ong Yu Rong. And meantime, take care.